Welcome back. You're watching The Market. And of course, we're in the thick of earnings season. Overnight, you've seen a great performance by Axis Bank as well. Over the weekend by Reliance, ICICI Bank. Markets, however, being dictated by global terms. But let's put the spotlight on SBI Card, where we've seen the net profit also rise, aided by strong sales. The asset quality has improved quarter on quarter. So what's the outlook going forward? I'm going to be in conversation with Rama Mohan Rao Amara, the MD and CEO of SBI Card. Thank you so much for joining us here. As we discuss the fine print of your results, let's begin with the asset quality. Can you evaluate for us, give us a sense of the quarter that's gone by, and more importantly, the expectations and guidance for the new financial year?
This quarter has been quite robust in terms of performance. We were able to leverage the revival in the consumer confidence and the business sentiment and positioned ourselves to perform very well on all the key business metrics. New card issuance touched a kind of highest in the history of the company. We crossed 1 million mark, aided by both the banker channel as well as open market. Both contributed in equal proportion. Spends, both retail and corporate spends put together, crossed 55,000 crores during the quarter, December quarter, with a 47% year-on-year growth. This has actually helped us build a very healthy net earning assets, which helped us crossing 29,000 crores, which is again a 13% year-on-year growth. All this culminated in a good revenue growth of 24% year-on-year, comprising both growth in interest income as well as non-interest income, and helped us in terms of meeting the festive spends. Typically, we make a lot of offers, etc. during the festive period. The robustness in the revenue helped us in terms of absorbing this cost and still ending up with a positive growth in operating profit. With the credit cost trajectory being continuously on a downward trajectory, we got the benefit by way of lower provision. Of course, I'm talking about excluding the 76 crores contingency provision what we made, and we ended up the quarter with a 84% year-on-year growth.
Now, we've heard from a couple of players in the industry that, the credit line utilization has gone lower. Is this a trend for SBI Cards as well?
When I look at our own performance in terms of metrics like growth in receivables, growth in spend per card kind of metrics, there is a kind of good robustness. We have seen in Q3, the spend per card improved to more than 1.7 lakhs in annualized terms. Receivable level has recorded a growth of 13%, having crossed 29,000 crores at aggregate level. And the revolver remained at 27%. So all these things point to a robust line utilization. Without that, it is not possible to have this good performance in spends as well as the receivable level. So we have seen quarter-on-quarter improvement, and we are almost near the pre-COVID level in terms of average credit line utilization at the portfolio level. But it does vary from vintage to vintage, but at a portfolio level, we are almost nearer to the pre-COVID level.
Now, for the quarter gone by, your NIMs have come down and your cost of funds have also come down. When do you see them stabilizing?
Yes, NIM is a function of yield on the portfolio and, of course, the cost of funds. When you look at Q2 and Q3, revolver stabilized at 27% in terms of its share, and EMI portion increased from 29% to 33%. And with a kind of upward bias in the interest rate scenario, what we are seeing externally, we hope the yield has bottomed out. And we have always been prudent and having a very deft management of working capital management in terms of borrowing at a very optimal cost. We continue to do that. In fact, the good story during the last couple of quarters has been we increased the share of long-term borrowings from 24% to 36% over a year. But still the cost of funds has been brought down. So we continue to be vigilant, and we are hopeful that the possibility of the NIM going further down in a significant way is very minimal.
No, interest rates have bottomed out and asset quality has improved. What are the feelers you're getting from on ground? Do you think a lot of the COVID provisioning which you took is behind us, or somewhere Omicron concerns could hit us in this quarter? Because Omicron, in a sense, sir, was not a Q3 phenomenon, it will be a Q4 phenomenon.
We have seen, particularly after wave 2, the collection efficiency and recovery efficiency both are actually coming back strongly. Of course, it has been improving day by day. If I look at the BAU portfolio, which is a business as usual portfolio, it has been holding good. We are almost nearer to the pre-COVID level in terms of collection efficiency across the buckets. Individual bucket may vary, but across the buckets, when you look at the collection efficiency is on par with almost on par with pre-COVID level. RBI RE portfolio, of course, we were creating a kind of management overlay every quarter. Whenever the flow rates were higher, obviously you see a higher write-off from the portfolio. But the creditable thing is, like, we have seen the share has come down from a 9% highest when it was highest at September quarter last year. It has now come down to 2%. And the two out of this 2% portfolio, also 70% of the portfolio is almost regular or otherwise less than 30-day delinquency. Only 30% is in 30 plus kind of buckets. So we have recognized the stress fully, and as a matter of prudence, we have created a 76 crore unallocated contingency reserve to take care of any eventuality. But at least the initial trends during the month of January indicate that it has not, our efficiency has not suffered much.
Sure. Mr. Rao, have interest rates bottomed out according to you? And if so, what will be the impact of increasing interest rate environment on your business and, more importantly, your profitability going forward?
Interest rates wise, I mean, we have seen a kind of short-term rates hardening. We have seen the 10-year G-Sec, a kind of rate yield is hardening, which automatically translates into higher borrowing costs. But we have been prudent. We looked at the right opportunity, right timing, and increased the share of long-term borrowings from 24% to 36%. So that way, we have created a kind of mitigation against the possible increase in the interest rate scenario. But at the same time, cost of funds wise, when you look at, we have enough levers. We while maintaining the liquidity coverage ratio at optimal level, we also leverage the various instruments that are available. We have a lot of interest from the banks to participate in our consortium lending. So this gives us short-term borrowing at a very optimal cost. So we are hopeful of maintaining the margin. But when it comes to profitability, interest contributes only around 44%, 45% of the overall revenue base. Remaining amount contributes from fee income, non-interest income, and that has been a very robust last few quarters. So we don't foresee any increase in the interest rates having any debilitating impact on the profitability.
Sure. Could you also give me an overview of how many cards were issued digitally, and what are the other digital initiatives that you plan on taking?
We have been working on digitization, particularly digitizing every step of the customer journey once they're onboarded. To tell you, like, to share with you, our ETB, the existing customer, the entire journey has been digitized. Whether it is applying for an additional card, getting an additional card, credit card, it is instantaneous now. We logged almost 42,000, 43,000 kind of Insta cards in the December quarter, which are additional credit cards issued to the existing customers. When it comes to cross-sell by way of our loan offerings to the existing customers, 70% of the cross-sell volume comes through the digital channels. So we have invested heavily in digitization. Now the focus is on digitizing the NTB, that is a new to the bank customer journey. This project is underway. In the next few months, we'll be able to complete this journey, whereby this will give an opportunity for us to digitally onboard even a new customer. Secondly, in terms of engagement with the customer, we have been investing heavily in hyper personalization, where this is a kind of maturity journey, where one needs to get the capability of making a right offer, relevant offer at a right time through a right channel to the customer. We are at certain level of maturity in this journey. We have invested heavily, and this is another project which is going on, which will help us improving the engagement with the customer so as to get better returns out of the marketing spends.
Now, union budget is not far away. 1st of February is almost here. So if I could ask you for your budget expectation or recommendation of what can be done to ensure that, consumer demand very much continues, and at a time when inflation rates will go up. It's not about if, but when.
We are hopeful that this budget will continue to be pro-reform, and government will be undertaking a lot of initiatives aimed at accelerating the pace of economy. They have been doing it, and this budget also we have a similar kind of expectation. But being a player in the payment industry, my expectation from the government is to further incentivize the digital payment penetration, and also bolster the payment infra creation across the country, so that overall the digital adoption will increase further.
Okay, we'll leave it at that. That's SBI Card for you, decoding the earnings as well as giving guidance on the road ahead and, of course, budget expectations.